Hello, Smart Money Tree podcast listeners. Welcome to this week's show. My name is Kirk Chisholm, and I'll be your host. So today I'm joined with Lucas Siegel. How you doing today, Lucas?
Great. Thanks so much for having me.
Well, glad to have you on. And so, Lucas, the listeners, just so you know, I love talking about alternative assets, and I know the listeners really love me talking about them because it's just interesting and different. You don't hear it anywhere else. So we wanted to bring Lucas on to talk about an interesting one that I've known about for years. So, Lucas, tell us a little bit about your background.
Yeah, so I've been in the financial services business for about 15 years, specifically on life settlements. I started at a hedge fund or private equity fund that was life insurance policies from the market and bundling up for institutional investors and funds. So I've been on the buy side, and after years and years and years on being on the buy side of the transaction, I realized there was just an incredible amount of inefficiencies in the market. There's in this alternative asset space, as far as life settlements go, there's a lot of people making a lot of money off of the opaqueness of the transaction. So I left the buy side to build Harbor Life Brokerage, where we've really centralized the world's biggest buyers and institutional investors in life settlements into one place and built a HIPAA compliant blind bidding online auction where if someone wants to sell the policy, we can list it for them and they can get every major buyer in the world competing against each other to drive up the price if someone's interested in selling the policy.
So it's interesting. So let's get into this. I got tons of questions here because this is fascinating space.
Great.
So tell us, what is a life settlement?
Yeah. So a life settlement is a result of a 1911 Supreme Court ruling, Grigsby versus Russell, where the Supreme Court ruled that life insurance is your private property. Just like a house, just like a car, just like the shirt off your back, it's your asset and you have the right to sell that asset. So you have the right to sell, let's say you're 80 years old, you've got $1 million life insurance policy. You can sell that policy's future death benefit for a discount today. So we might be able to get you $500,000 in cash today. And then that institutional investor will take over the cost of paying those premiums for your policy. And when you pass, they get the $1 million.
Okay. So why would somebody want to do that?
A lot of reasons. First of all, if you look at estate exemptions, it's gone up and up and up and up. So a lot of people got a life insurance policy to protect their estate, and then those exemptions have risen. So they don't necessarily need it anymore. With inflation, a lot of families are seeing their dollars go less far and their disposable income being eaten into. And so they see this as a cost, keeping the life insurance policy as a cost instead of an asset or someone's children. Their children's are grown up and they don't need the money anymore. Or they need to pay it for senior living. They've got a liquidity event. And a liquidity need. And so this is an opportunity for a family to look at what the net present value would be and help make a good decision. The other reason is investment. We have a lot of families that are super high net worth that we've worked with where they just don't see the ROI in keeping the policy, and they would rather take some cash out today and reinvest those assets into an asset class that was more distributed to their risk category.
So is this all life insurance or certain types, or how does that work?
It's mostly universal life and any kind of UL chassis, so IUL, SUL. So it's that guaranteed fixed products that are the best. But there's also like a lot of term conversions. Where we'll work with a financial advisor or an agent. And like this morning, I got a $25 million in term conversions on a 69-year-old. And that client would not necessarily keep that policy and convert that term into a long-term universal life. But if they could sell that term, which helped them have coverage that they needed for a certain period of time, and convert it into a universal life policy that could then get purchased, that client would then not have to throw away their policy. They could get cash now. That advisor would get compensated on the conversion, and it's a win-win-win.
Okay. So now, if I'm thinking about these policies, right? So somebody has life insurance on themselves and somebody else is, and then they're selling it to somebody else. Tell us a little bit about the process of how that works. Like what happens, who's doing what, just tell us a little bit about that.
Yeah, absolutely. So we're a broker. So we're a licensed fiduciary for the families. So our job is to represent the families and those advisors in the best way humanly possible within the market. So if a family wants to figure out how it's sold, a lot of times investment advisors will actually, in annual reviews, work with us, and we do free underwriting so that they walk into that annual review with the family understanding the potential liquidity of those assets. Because most financial advisors, when they're looking at liquidity ratios of families, they don't take that into account. They just look at the cash value. So during annual review, we'll come up with we'll work with that advisor and come up with an initial analysis based on a couple heuristics about life expectancy, and figure out what that value of that policy is. If a family decides they want to move forward and they're just, even if they don't want to sell it, but they want to understand what it's worth, we've got a 3-page authorization, and we go get the medical records, we go do all of the internal underwriting, and then present the family and the financial professional that represents them what their options are. What is it worth? What do we think the market would go for? Is it worth keeping? Is it worth selling? Is it worth surrendering? And what are their different options? And we just lay it out.
So let me ask you this. What's the, as an investment, what's the viability of it being investment? Like if I was saying, all right, I want to put in whatever, $50,000 into a life settlement, how does that work? How does it become an investment? How does it give me a return? How does that work?
Yeah, so there's funds. There's funds that are aggregators of policies. Just like, if you're looking at mortgages, for example, you could invest in someone's individual mortgage, but you've got their risk of not being able to pay that, and then your investment's gone because all of your risk is on one single case. So there's funds out there that are aggregators where they buy based off of their specific criteria of what they think is good longevity risk analysis, with different elements of what types of policies they'll buy. And that's how most people invest in life settlements. They don't do buying individual policies. They invest in a group because it spreads that risk out for longevity. Because in the end,
but I'm asking
as an investment.
Yeah, I'm asking how it works as an investment. I don't mean a fund. I mean, just trying to educate the listeners here of how it actually works.
Got it. So let's say someone's got $1 million policy, and they've got a 7 to 10-year life expectancy. You take the premiums that are going to be required to pay that policy until the maturity rate, the death date. And then you've got an internal rate of return that's your hurdle rate, and that pumps out an MPV. Does that make sense?
It does, but let's put that in plain English for the listeners that don't understand all the financial terms. So basically, you're taking whatever $1 million policy. Let's just say $1 million cash value, whatever it is, and I sell that to you, and you're going to pay me a certain amount, right? So based on that, well, how would that work? Just use example numbers.
So let's say you're 80 years old and it's a $1 million policy. Let's say that I would have to, because of your life expectancy, the policy still needs to keep getting paid into, which is the problem that most families run into. If I was buying it, then I would take over the cost moving forward. You would never have to pay a premium again. But as the investor, I'm going to calculate how many premiums do I think I'm going to have to pay until you pass away. where that $1 million policy would then be me as the beneficiary. Does that make sense?
Okay. So basically what you're saying is that I stop paying. So as my policy, I decide I'm going to stop paying on it, but you're going to pay me some money to take it over, even though it's still based on my life. And you're going to continue to pay the premiums until I die. Is that correct?
Correct.
Okay. So, as an investor, it sounds like you're paying me money up front, and then you're continuing to pay premiums every year until at the end you get some sort of a death benefit. Now, it sounds to me like there's a lot of assumptions that go into this, right? You're assuming
Absolutely.
that I'm gonna have my life expectancy. I mean, obviously you have to continue to pay. If you don't continue to pay, then the whole thing blows up, right?
Yeah. So that's a great point. This is considered a non-correlated asset, but the risk you have in this investment is longevity risk, because the longer someone lives, if you think someone's going to live for 10 years and then they end up living 12 years, that eats into your return because you have to continue to pay those premiums. And so that's where, certain people invest in funds, because those funds will spread out that longevity risk across a bunch of policies. But for people that have a life insurance policy, families, they hold 100% of that extension risk for their own policies. Because if their mom or their dad or themselves end up living longer than they expected, that family has 100% of the risk of paying those premiums for an extended period of time. Does that make sense?
Right. So, so obviously you're coming up with a approximate annual return based on these numbers, right? Which you can't predict. I mean, life insurance companies can speculate based on millions and millions of people, and they'll come up with a number. But obviously, you don't know. Somebody could live to 110. They could die the next day, right? So it sounds like presumably if they die the next day, that's a great return for you. If they live till 110, you could probably lose money, right?
Yeah, yeah. I mean, policies can go underwater depending on the longevity risk. We work with, before we take a policy to market, we get a third-party actuarial valuation of the life expectancy of the insured. And then we've got our online auction, which has got most of the biggest buyers in the world all in one place competing. And what's interesting is when you look at longevity risk, a lot of buyers will look at the same life differently. Some of them have big medical underwriting teams in-house. And so they might not take the life expectancy that I provided to the market. They might have a different opinion. So the variability about what the purchase price can be vastly different, which is the benefit to having it on an auction so the whole world can see it and you can get differing opinions and then force them to compete on those opinions.
So, it's interesting because, I looked into this space many years ago and it was not, well, let's just say it was still disjointed. It was still kind of all over the place. And
yeah,
I talked to one of the bigger firms and they said they were trying to get it a little bit more of a centralized market. The problem is when you have a centralized market, it squeezes the margins and the returns get reduced, right? Because you can't find great deals. You can, but they're harder to find. And it's like the stock market. You can't get good deals, right? You can find things that are mispriced, but everyone else is looking at the same stuff you are. So you can't find great deals. Whereas real estate, you can find great deals just because somebody didn't know something was on the market. So, why would that be a good thing for investors if the markets are more centralized now?
Increased deal flow, because when things are less opaque, consumers feel like they're more protected, and they are more protected. And that makes, there used to be a bit of a Wild West game with life settlements, which is something that we're trying to very adamantly be the forerunner in solving, and saying like, look, this is regulated, this is industrialized, this is a safe thing for a family to do. And so when you get that more broad-based acceptance, inventory goes up. So the amount of policies that can go on the market increase. But you're 100% right that competition does drop returns for funds. And that is kind of my job. My job is to represent families and financial advisors to get them the highest price humanly possible.
So what are some of the risks involved with this as an investment?
You've got tail risk, which is some policies mature. So a policy might end at age 101 and there's no ability to extend it. So you paid all this money, woohoo, you're 101, and now your policy's gone. So that's a risk. And then there's longevity risk. So if this person lives 25% longer than what we think, if I was an investor, when am I going to break even or lose money? And so that's the break even risk.
Okay. What else?
Well, you've got concentration risk, which really compounds those two. Um, if you don't buy a bunch of policies, if one of the ones that you bought has, an extension on longevity, it can tank the entire portfolio. So you need to have a bunch, as well as face amount distribution. So if you're just buying really huge policies, there's a higher chance of getting squeezed.
Okay. What about perfecting the title?
So title is a big deal. There is an arduous process with protecting title, and we have never seen it be an issue because it has been so deeply developed. So, like for example, beneficiaries need to sign off. If the insured is selling it, they need a doctor saying that they were mentally competent enough to do it. Power of attorney, trust. If there's a divorce, so like we just closed a case from a 79-year-old that was divorced in 1986, and he got the policy in 1985. So we had to get a divorce decree from 1986 to help prove title.
Okay. So you're saying that's not a problem anymore?
No, not that we're seeing. But
Okay.
I'm on the brokerage side. I'm not on the fund side anymore. So it's not my job is to help the fund get what they need so that they can acquire the policy to help the family. My job is not to cover the institutional risk for the buyers.
Okay. So what's the kind of range that people can look to expect with these type of life settlements?
As an investor,
Yeah,
is that
just
what
a
you're
range.
asking?
I mean, obviously, yeah, we're not asking you specifically, but just like a range of what you're kind of seeing in the market now.
So we see policies sold at anywhere from 6 to 13% IRRs.
Okay.
But that's based off of a life expectancy that we have. If someone thinks has their own internal life expectancy or gets another life expectancy, the number can be vastly different based off of the same insured.
Right, but that's the
Um,
target number you're shooting for.
and we've seen a lot of funds underperform. Right now, there is too much money in the space and not enough policy flow to float it. So I would say it's very much a seller's market versus a buyer's market.
Yeah, that's actually a great point. So if it's a seller's market, then it must be really hard to find deals at all in this market. And what do you attribute there to the reasoning to be too much money and too few policies?
Um, I think it's just a lack of awareness. I mean, there's hundreds of billions of dollars every year of life insurance that's lapsing that the families could have sold. And the families aren't being told that this is an option for them. It's a lack of awareness with financial advisors. It's a lack of awareness with insurance agents. Big wirehouses refuse to let any of their producers let people know. And it's a shame because if you went to your financial advisor and said, hey, I want to leave my house, I can't afford my house anymore, would your financial advisor tell you that you should foreclose on it? Or would your financial advisor say you should probably try and sell it?
Well, I mean, to be fair, the industry changed names about a decade ago. It used to be called viaticals, right? And there was a big problem with that. And I mean, maybe you can kind of get into that and what the industry's done to change it, because that is one of the main reasons why a lot of firms don't allow it.
Yeah. Yeah. So life settlements really started with the term viatical in the 80s, which was during the AIDS crisis. And you had, these guys that had really gotten AIDS and they knew they had AIDS, but they hadn't been tested yet. And they'd go get a big life insurance policy. And then, 3 months later, go get tested for AIDS and then sell it for astronomical amounts, because this is before the pill came out to help those struggling with AIDS and extend life expectancy for patients with AIDS. So it was basically a death sentence. So all these transactions happened where people got this life insurance policy, and then had some health issue with AIDS, and then flipped it for $1 zillion, and then the pill comes out to help these patients, and it's no longer a death sentence. And a lot of investors got burned. So there's been a ton of regulation in the industry, over the last decade, including disclosure laws, having to have a provider within the transaction, title. There's been a ton of transparency that's been brought into this system, and our goal is to increase it even more.
So what does that look like when you have kind of an auction? Is it kind of like like an exchange, like a stock market exchange, where people are all going to one place and putting in bids, or how does that kind of work?
Yeah, it's a lot. It kind of looks a lot like eBay, but HIPAA compliant and secure. And we've got all these institutional buyers that are in there, and we'll do an auction for 21 days, and people put in a max bid or a min bid, and we have cases that'll rack up 65 bids in 21 days, and they just go crazy. And it's beautiful because when we're presenting to a financial advisor and a family, we've got an audit trail so that they know, hey, this is how I got the highest price possible. We can show them bid history by the second, by the minute, which gives families peace of mind in knowing that their fiduciary best interests were taken care of.
So have you ever waded into this kind of similar territory? I know the life settlements is certainly one, but there's also like lottery winnings and any sort of kind of related areas where there's cash flows into the future and people are basically paying up. Do you get into those at all as well?
We do not. Maybe in the future we will, but right now there is, I think, such an opportunity to help so many families that needs to be unlocked, that we're just focusing on settlements.
Okay, cool. All right. Well, as we get kind of close to wrapping up here, what else do you think that people should know about this asset class?
I think the most important thing is for people to understand, and advisors to understand, that it's your asset. This is something that you own, and you have every right to know the true value of this policy. Typically, people need to be over the age of 65 or 70, even 75, because there needs to be a life expectancy typically under 15 years. But this is information, people know the value of their house. People know the value of their car. People know the value of their 401k. Our goal is to help people understand the liquid resale value of the life insurance policy and make sure they're treated fairly in the transaction.
Okay. So one final question I had was inflation. I mean, we have high inflation and these rates are reasonable, but inflation obviously impacts this, because I remember years ago when I looked, the rates were lower. So how does inflation impact this, and how does that kind of run into the calculus?
So there's two main ways that inflation impacts this. One is that people's purchasing power is dropping, so their disposable income is dropping. And they weren't expecting to be burdened with this as much. And so these costs that might have been nominal at one point, as people are retiring and living off of some sort of set standard for how much they can spend per month, when all these goods start costing more and our government continues printing money, um, it makes paying the life insurance policy more difficult. The second thing is that we are essentially, with this high inflation, we're essentially deflating what a life insurance policy is worth. Because if it's worth $1 million back when inflation was 3%, 4%, to now, every single day as inflation rises, that future death benefit is worth less to you. So we have a lot of families that take that money, sell their policy now, and go invest that money into some sort of inflationary hedge.
But isn't that, to be fair, I mean, it's like a mortgage, right? And, the value doesn't change, like the death benefit doesn't change, but neither does the premiums, right? So even though inflation's going higher, and yes, it's devaluing the death benefit, it's also devaluing the premiums, right? So the only issue would be is if we have stagflation, which means you're not making more money, but everything else is deflating.
Well, the premiums do go up typically. It depends how the policy is funded, but many cases we see the premiums going up and up and up and up.
Oh, so every year they go higher?
Yeah.
Okay. All
It
right. So it's not
depends. It
really a
depends
fixed
on
rate.
how. No, it's not. Whole life is more fixed rate, but universal life is built to have the flexibility, but that flexibility backfires on so many families. That's why I think it's 87% of all life insurance policies never get paid out to the families.
Oh, well, that's that's
I
a
mean, are
lot.
you kidding me? Yeah. So just letting people know that, hey, this is an asset and you might as well figure out what it's worth. Not doing that is a tragedy in the finance business.
Yeah. So do you ever have people that get a little concerned because if you're basically selling somebody the contract on your life, you're kind of selling your soul to the devil. Or do people get worried that somehow they're going to meet an early demise because someone else has a contract in their life?
We get that question every once in a while, like, are you selling my policy to the mafia or something like that? No, we're not. All of our investors are institutional investors. So like we work with Berkshire Hathaway, we work with Apollo, we work with big financial institutions. And what I tell families is like, you're honest. I mean, this sounds rude, but you're just a number on a spreadsheet. And your longevity is looked at as a number, not necessarily as a name. Um, so I wouldn't be worried about it. If my family needed to sell their policy, I would sell their policy in a second.
Okay, cool. All right. Well, what are some final thoughts you can leave us with, and where can people find more about you?
Yeah, go to harborlifebrokerage.com. And there you can just submit a contact form if you have a policy you want us to look at. If you're an advisor and you want to set this up for annual reviews so that your clients can just automatically get that, it's a great way of letting people know what the true liquid asset value of their policies are. Most of them are completely unaware of it. Never let a policy lapse without getting it looked at. And we're here for you as a fiduciary to do everything we can to protect as many families as humanly possible and preserve wealth in America.
Great. Well, Lucas, appreciate you coming on the show and sharing your wisdom with us. I always love these conversations with alternatives because it just opens people's mind up to a different type of investment out there that they probably haven't even heard of. So thanks for sharing with us.
Thank you so much.
Hey, Doug, did you hear? We're giving away free money. Well, I'll tell you about it in a minute, but before I do, there's a saying in the mining community, well, precious metals mining, that is. The saying is that if you want the best deals, you have to be in the room. Now, you're probably thinking, what does it mean to be in the room? Well, I'll tell you. Being in the room means that you're on the short list of people who get invited to be a part of the best deals. These are the deals that most investors will never have access to. You mean like IPOs? Nope, IPOs are chump change. Those are for retail investors, small potatoes. That's nothing compared to these deals. These deals would have you salivating to get access to them. Once you know they exist, you will never look at investing the same way again. I almost don't want to even tell you that they exist because it will ruin your thinking of how the investing world really works. Now, you might be excited that these deals exist, but you only have access to the deals if you're an insider, or in the room, as they call it. Now, as loyal listeners to the show, I'm going to give you a chance to be in the room. Money Tree Investing Podcast has created the Insiders Club. This is a community of our show's members who are loyal listeners of the show and want to get more out of their investing experience. Being a part of the Insiders Club gives you insider status for upcoming events and webinars, discounts, free stuff and books, and influence on the future direction of the show. This is a great opportunity to join us as we expand our content and services. Oh, and did I mention free money? Yes, in the next few weeks, I'll be giving away free money to our members of the Insiders Club as my appreciation for listening to the show. Now, there's no cost to join the Insiders Club. Just go to moneytreepodcast.com/free money today to join the community. That's www.moneytreepodcast.com/free money. I hope to see you in the room. All right. Well, that was a great interview with Lucas. Really appreciate him coming on the show. I always enjoy bringing on people who specialize in certain alternative assets. As the listeners know, I love alternative investments, not because they're better, but just because they're different and they allow you to expand your mind into what's possible in the investing. So now we're in the panel portion of the show where we have our very own Tim Baker. Hey, Tim.
Hey, Kirk, how are you? Thanks for
Good.
having me.
Yeah, thanks for coming on. And we also have our very own Phil Weiss. Hey, Phil.
Hey, Kirk, good to see you. Thanks for inviting me.
Great. Well, let's dive right in. So, Tim, what were some of your takeaways from the interview?
Yeah, as you and I discussed, this is pretty nuanced, right? So life settlements is a pretty specific thing, as you and I discussed. It's probably not front and center on everybody's mind when they're buying life insurance. So they're buying life insurance because they can do so for a reasonable premium, and when they die, their loved ones or their estate will be taken care of. I have my own thoughts on the value of life insurance, which we may not come back to later. But selling it is certainly not, I don't think, front and center on somebody's mind in terms of how they're going to approach that insurance and how they're going to dispense with it later. But so I think you made a good point earlier. You have to think about not necessarily like what is it and what's it going to accomplish for you, but like what bucket does it sit in? If you think about a well-diversified portfolio, where does it fall into your cash and cash equivalents? Does it fall into a bond-like investment? Does it fall more into an equity-like investment, alternatives, things like that? So it's an interesting conversation, but I do think it's pretty nuanced.
All right. Well, Phil, what are some of your thoughts? What are some of your takeaways from the interview?
So, like Tim said, this is a more nuanced product. It's not something that I have dealt with my clients, but it is an interesting thing to think about in terms of you have permanent life insurance and maybe you need the money now instead of waiting till the future because of the way that your financial plan looks or your outlook looks. So this is an opportunity to be able to take that and turn it into something that can help you now as opposed to in the future. So it makes it a little bit different. How to classify it is an interesting question. It's definitely an alternative, but it seems like there's some fixed income type elements that it might have as well.
Yeah. So let's so one question. I mean, I enjoyed the interview with Lucas. I think it was, I love this as an asset class because I think it's different than most people are accustomed to, but it definitely has some risks. So, we talked a little bit about why a seller should consider this, but why should a buyer consider this? What are your thoughts, Tim?
I mean, to me, it's I'm not 100% sure. I don't sell insurance. I don't, in fact, frankly, I don't do anything commission based because I'm a registered investment advisor. But from a seller's perspective, or excuse me, a buyer's perspective, you never know. I mean, I don't know all of the rules around it. But if I was wealthy and found out I was going to die in a week, certainly I'd want to go buy $1 million insurance policy for 500 grand. But there may be rules that say you have to get a health check, or I don't know what some of the rules and regulations are around doing that. But you could also, I mean, more sincerely, I mean, obviously insurance premiums change over time, right? Interest rates, discount values. So if somebody can buy, an all paid up insurance policy that, that is much more advanced in years, and take on a premium that would be less than what they would pay uh, for buying at current rates, certainly it would make sense to do that. And then they do still own that insurance policy, which becomes an estate planning tool. Or you never know, somebody might be looking to trade it, making a bet on, something changing in the value of it, and they could turn around and sell it for more. But yeah, I've always thought of life insurance as more of an estate planning tool. So I did understand what he was saying about why somebody would want to sell it. As far as why somebody would want to buy it, there'd have to be some pretty strong incentives.
Yeah, yeah, that's for sure. Phil, what are some of your thoughts from like the buyer's perspective? How should a buyer look at this?
So like Tim said, I don't sell products either. But in terms of that, I guess I'm thinking of it that from the buyer's perspective, I assume that they have some actuaries or something like that that's kind of taking the data on the person who has the policy and getting an idea of what their life expectancy might be. And then they're trying to forecast like what their cash flows are. And if they can say, I'm going to put in, let's say $600,000 today, and I'm going to get this policy that's going to pay me $1 million. And based on the averages, that kind of helps them forecast out their cash flows and grow them in a different way. So I just think that, to me, they're looking at it as part of their portfolio and have different maturities in terms of things that are going to be coming in. Obviously, we don't really know what the life expectancy is going to be. So there's going to be times that you get these things and you're going to collect sooner, but there may also be times where it takes a lot longer.
Yeah, I think, the challenge, and I'll kind of dive into this a little bit because I do have some experience in this, not investing wise, but in terms of research in the area many years ago. This was a great income alternative many years ago, right? Because interest rates were zero and you could probably get 6 or 7% way back, you go out 20 years maybe for a policy, but it was an interesting idea as a way to generate extra income. But now income rates are higher, so theirs are less appealing because there is some variability for the yield. It's dependent upon the person, and you probably don't want to buy one of these because if the person ends up living to 120 years old, you're going to lose money. If they end up dying the next day, you're going to make lots of money. So you're basically basing it on the lifespan of this person. It's better off buying a portfolio of these so that you're reducing your risk. And ultimately, the actuarials will win out. It's like the casino. It's like the house, right? You can win at any given time, but over time, you're going to lose money at the casino. And I think the actuaries, it's the same way, right? They come up with a number. The number is generally pretty accurate over a large number of people. But the smaller the number of people, the more variability there is, which means that the less likely you are to reach the kind of the target yield that you're expecting. So, I think it's an interesting income alternative for the fixed income portion of the portfolio. It's definitely not for everybody. But I think for people who are, if you can, one thing I did find is that there are definitely people who are buying these pools and actually can make good money at them, but that's their expertise. So this is one of those things, if you're good at it, if you know what you're doing, if you do this all day and every day, then it's a reasonable asset. But if you're just thinking, hey, I'm just going to add this little thing to my portfolio, make sure you're working with a manager that's really good at what they do, because there's a lot of pieces of this which will make it challenging for you, I think, if you're not an expert. So
yeah, and I hadn't thought of that, frankly. That makes way more sense to me, Kirk. One of my first jobs in my career was working on Citigroup's mortgage-backed desk. I probably shouldn't say that since I was doing it in the mid 90s. But yeah, I mean, it's, for somebody to come in and buy your mortgage, that doesn't make any sense. But for somebody like Citigroup that can buy thousands of mortgages and bundle them up, and I'm making it, the more I say this, the more I'm chuckling at what a horrible example this is because of everything that happened in 2007. But it's a similar idea in that it's very much an institutional play. And so I'm just kind of reinforcing your thought there that this is probably not for something for like one person to do with one insurance policy. Pooling it makes way more sense to me.
Yeah. Yeah. I mean, I want to kind of dip into a related area, which I think is, I alluded to in the show, but people might not have picked up on it. So with the life settlements, that's based on life insurance. There's a related area, which typically people who buy life settlements also are looking at similar products, and these products would be lottery winnings, or payments, settlement payments. So like if you have a class action lawsuit for, let's say you win the lottery, let's use the lottery because everyone knows this example. You win the lottery, let's say you win $100 million. You have a choice to make. You can either take that as a lump sum, which case they're not going to give you $100 million. They'll give you 50 million, let's say. So you could take your 50 million today, or you could take your 100 million over 20 years, right? So basically 5 million a year over 20 years, and that's the lottery winning. So that's how they pay you that $100 million. Now, that in itself, some people choose to take the income stream. They take the 20-year, $5 million a year payments, which, depending on the numbers, may or may not make sense. But then they'll look and they'll say, well, I actually need more money now. So then they'll take that payment stream and they'll sell it to somebody else. So somebody like one of us would buy that payment stream, and we would give them a discount, right? We'd give them a discount on that. So instead of them making $100 million over 20 years, we would give them the 50, right? Let's hypothetically say we're giving the original deal that the lottery would give them. So but then you could argue whether 50 is a good number. Maybe it's 60, maybe it's 40, but the reality is you're basically looking at payment streams. And so the structured settlements, the life settlements, the structured settlements, and then the lottery winnings are all kind of follow the similar path where you're basically trying to negotiate cash flow streams. And ultimately, you're trying to find a good cash flow stream that is non-correlated to the market, right? Which is why you would do this. That's why alternatives make sense. You're trying to find a non-correlated asset to other assets that are maybe more traditional, like, treasuries or agencies or mortgage-backed securities or whatever. You're trying to find something that's a little bit different, that's diversified in the cash flow streams. There might be some benefits and drawbacks, but that's why you would consider it. So, Phil, would you ever look at something like this for your portfolio if you're looking for like non-correlated income streams?
I guess for specifically looking at life settlements, I think the only time that I would is if I had an opportunity to buy into something just like the mortgage-backed securities work, where somebody else had created a pool of life settlements, and I might have an opportunity to buy an interest in that. Because as Tim said, I'm not going to buy one of these or two of these or even 10 of these, because it could work for me or against me. There's a lot of variability, and I don't have the expertise to be able to make those calculations in a good way. I'd want to rely on somebody else's expertise. So I would only consider it if there's an opportunity to participate in one that already existed.
Yeah. Okay. So let me kind of open it up here a little bit. So Tim, if you're looking at portfolios, and obviously the market's changed in the last year, and we've seen a lot more interesting opportunities certainly than we saw a few years ago. Have you ever considered alternative assets, for cash flow streams for people, or are you more focused on the on the traditional side?
Yeah, first of all, thanks a lot, Kirk. I now have the J.G. Wentworth song stuck in my head, which is, other than the Burger King song, my least favorite commercial song ever. I can't change the channel fast enough. So we tend to shy away from alts. And, as you and Phil are kind of alluding to, we leave that to the experts a little bit. The data is very mixed on how alts perform in portfolios. I don't think from the perspective you're talking about, Kirk. I'm thinking more like, beta neutral types of portfolios, and, how those impact returns and all of that. From an income stream perspective, Better or worse, we're pretty traditional. We try to do that by managing around cash, bonds, and stocks, meaning, if somebody needs income within the next year, we'll keep that in cash just to make sure that that money is guaranteed to be there for that year. The next couple of years worth, we'll make sure is in pretty conservative short-term bond portfolios that yield a little bit better than cash, but can still be relatively stable. Make sure that cash will be there for, those 2 years worth of income, and then the remainder in a mix of stocks and bonds that continue to grow and beat inflation. And then we just continue to rebalance that every year. I'm starting to, believe it or not, given what we talked about the first time we ever spoke, starting to think about possibly maybe sort of on some planet doing something with annuities. We would obviously have to do it from a fee-based perspective, which from the little bit of research that I've done, is actually a benefit to the client, because by doing a fee-based rather than an upfront commission, first of all, you eliminate the conflict of interest. And second of all, my understanding so far is that might eliminate some of the lockup periods, some of the illiquidity issues with annuities. But as it stands right now, I'll go back to what I said earlier. We take a pretty traditional approach and use asset allocation rather than alternatives to manage income for people.
Yeah, no, I appreciate that, and I think it's yeah, you're crazy. You're going to annuities.
I know, and it's and like I've got employees that are giving me like the evil eye, like, wait, what? Like, this is the one thing you yell the most about, other than mutual funds.
You and Ken Fisher, right?
Yeah, right. Oh God, I'm gonna go jump out my window.
Yeah, sorry to compare you to Ken Fisher. So Phil, what about you? Would you consider anything kind of outside the box, or what's the most outside the box you'd come get to with kind of like the fixed income or cash flow part of your portfolio?
At this point in time, I mean, what Tim described is very similar to what I'm going to do. I'm going to stick more with the plain vanilla type things. I want to rely on asset allocation. I do want to, for those that are in the drawdown stage, I want to pull money out of their portfolios. I want to make sure that there's cash that's there so that we don't have to sell at a loss. Because to me, like, one of the worst things I think we can do as investors is buy high and sell low, and I don't want to be selling low, so I want to be prepared for that. So I'm going to use money markets, treasuries, things like that for and just straight cash for those short-term positions. I laughed when you talked about annuities, Tim, because it's the same thing for me. I have had a couple people that just, based upon their risk profile, it could make sense to think about like a single premium income annuity or something like that, if I can put the right things on it so that they can get it for a certain number of years. I know the payout's less, but at least that way they're not, running the risk that they buy it and they're gone in 6 months and all that money is gone and it doesn't go to their heirs either. Because I haven't really done that. And if I'm doing it, it's only going to be in a fee-based context as well. So alternatives are not something that you're regularly going to find in my clients' portfolios either.
Or my favorite, that nobody selling annuities will tell you that you get taxed as income instead of capital gains. That's my favorite.
Oh yeah.
Bingo. Yeah, and Kirk, the other thing I would say is, this is not that you wanted to talk about this, and I'm sure you wanted to stay on the settlements and income and annuities. But last year was a textbook example of why people need to have at least some vague notion of a financial plan in place. Because it wasn't many, but it was at least a couple of clients that came to us last year and they were like, we need cash. And we understand emergencies, and we're always happy to help out, but that money should be in the bank. The number one rule, any financial planning software that you look at, screen number one after you put all of your information in will say liquidity, and it will tell you what you should have budgeted for cash and what you do have budgeted for cash. And just way too many people don't do that. The allure of the siren song of the S&P 500 is often very tempting, and I believe strongly in it for the long term. But people do need to have that emergency reservoir, because, like Phil just said, it makes me physically sick to have to go to a client and be like, okay, I'm going to raise $10,000 for you, but that $10,000, 7 months ago was worth 12,000. So it's really like we're taking 12,000 out to give you 10,000. And that's always pretty painful. So that's just a little side planning piece there.
Well, yeah, and I think you raise a great point, Tim, about liquidity, because you think about prior to last year when interest rates were 0 and, you know, pretty much you couldn't get yield anywhere. And you bought an annuity, you still didn't get yield, right? Using that old example, right? But you were locked in, right? And for anybody who doesn't understand annuities, what we're talking about, the difference between commission annuities and non-commission. Commission annuities typically have you locked in for like, you know, 5, 7, 10 years. And that's basically that the insurance agent who sells you the annuity makes a big fat commission on you, which is why they sell them. Traditionally, most of them are sold for the commission. Doesn't mean they're not doing the right thing by you. I don't want to characterize everybody poorly, but if all else being equal, they would sell you that because they're making a fat commission over selling you treasuries, which they wouldn't make a commission on. So just keep that in mind. But realistically, if you're looking at that for cash flow, you'd be locked in and now you can't roll it. Whereas, you know, if you had a laddered portfolio that was a little more short term, well, I mean, right now you're looking at bonds, a laddered short term portfolio makes a whole lot of sense because you're not, because stuff comes due and you just keep rolling it out. I mean, right now I'm looking at a interesting grid here for fixed income, and it's, you know, for most stuff that's pretty low risk, you're looking at 5.5%. Depending on how far you go out, might be 4.5%. I mean, that's a lot better than it was 2 years ago. And
which, by the way, you just confused the average retail investor. Average retail investor goes, wait a minute, the further out I go, the less yield I get. You know, so that's
talk about that.
Yeah, it's become a huge source of confusion for folks, and this kind of ties back to what you were saying about life settlements and structured settlements, which is it's all the same thing for anybody that comes from like an investment background as opposed to a planning or a sales background. Is it's all about interest rates and discount rates. You know, the average, and you know, you go look on CNBC or Market Watch, and somebody puts a $220 price tag on Apple. Well, all they did was take the next 10 years worth of earnings and dividends from Apple and use a discount rate to pull it back to the current. And that's your stock price. And that's the same as what the value of a structured settlement would be, same as the value of a life insurance. Anything that is a stream of cash flows is going to be a discounted rate. And so I think that is an important point of clarification for folks that don't do what we do on a day-to-day basis. Because you tell people, you know, I've got people that are asking about, hey, like if I can get 5% for 3 months, shouldn't I take that? Maybe. I mean, if you think you might need the money, but I don't know, the stock market might be up 10% in that 3 months. I have no idea. Like, let's build it into your plan. But when you start telling people, well, it's 5 for 3 months, but if you want to go out a year, it's 4.5, you know, the inverted yield curve, I think, kind of throws people off a little bit.
So Tim, before we move on, I want to ask you the question because you've thrown out the term discount rate a lot, and I would imagine most listeners are not familiar with that unless they have a background in finance. So maybe you can kind of explain that at a 6th grade level for us.
Yeah, I'll do my best. So, I mean, for the most part, a lot of it revolves around just interest rates in general. And, you know, for those of us that are in this industry, you typically use, you know, the 10-year treasury is usually the benchmark rate for lots of things, right? Mortgage rates, discount rates, that sort of thing. But when it comes to you picking which discount rate you're going to use depending on the asset that you're discounting, and I know I'm already beyond the 6th grade level, but it depends. The interest rate is going to depend on the stability of that cash flow stream, right? So on a structured settlement where you're getting paid an annuity stream basically from the state of Connecticut because you won the lottery, you would use a pretty low discount rate on that because you would give it a reasonably certain present value of those future cash flows. Whereas if you're trying to value, okay, let's use a stock that's been very popular in the news lately, Nvidia, right? Nvidia just had a blowout earnings report. They are, you know, being praised as the first company to put a dollar price on AI or artificial intelligence, all of those things. If you were going to value their future earnings, you would use what's called cost of equity. So you always have weighted average cost of capital, and part of that is cost of equity, part of that is cost of debt, and then that becomes your weighted average cost of capital. But so bringing that back to a simpler point of view is if you take 10 years worth of income, cash flow streams, and let's say it's got a future value of $100 million, in order to discount that down to what you would want to pay now, then you take that $100 million and you discount it back, say 4% over that 10-year period. And so maybe now you're saying that $100 million right now is worth 80 million. Whereas with NVIDIA, you might say now that it's really worth more like 65 million, because there's a huge amount of uncertainty and variability to what NVIDIA's earnings are going to be over the years. So so I think where you were talking earlier, something like the state of Connecticut, you would use a lower discount rate, which would give you a higher present value because there's greater predictability or stability to those cash flow streams over the years.
Okay.
Maybe that was more like 8th grade.
So
Maybe 9th, but that's okay.
can I just add?
Sorry.
Can I
Go
add?
ahead, Phil.
So I like to think of it, instead of using the term discount rate, think about it this way. If I had the choice between taking $1 today and $1 a year from today, knowing that inflation and other things happen and prices rise, I'd rather have the $1 today than the $1 in the future. So what the discount rate really does is it says $1 today is worth, let's say that the inflation rate was 5%, right? That's what I can earn. It's worth $1.05 in the future. So if I want $1.05 in the future, I get $1 today. So it's really trying to take that future sum and bring it back into what it's worth today, assuming that we have inflation and other factors that are going to make its value change over time, just from the natural course of things.
Awesome. Phil, you got the gold star. That was a 6th grade level.
That was much better.
Sixth
I'll
grade
jump
level.
off, guys. Thanks for having me. Take care. Have a good one.
Mic drop. Great work, Phil. All right. So in terms of, as we kind of wrap it up here, let's kind of just dip into the fixed income market here, because things have changed a lot. And I just kind of want to get an opinion from both of you, because you're both really smart people when it comes to portfolio analysis. So what are your thoughts on fixed income now, and what would you look to do in the near future, considering where things are now, where you think things are going? So why don't we start with you, Tim, and then go to you, Phil?
Yeah, and when we first met, I discussed the fact that the first 12 years of my career were actually on the fixed income side. I worked on the trading desk for CDs and government bonds, and then on the corporate desk for Citigroup. And then I moved over to do corporate bond research also for Citigroup on the retail side, and then on the institutional side. So it's something that's kind of near and dear to my heart. And I do spend a lot of time thinking about the yield curve, even now that I'm more catering to the retail investor than the institutional investor that I used to cater to. So I thought you made a great point earlier, Kirk, when you say like a short-term ladder, because I think the entrenched conventional wisdom for the investor is, well, I'm going to ladder bonds out for the rest of the time that I need them. So if I know I'm going to need income for the next 15 years, I'm going to ladder my bonds out for the next 15 years. And that might be the right thing to do. But I do think, the number one thing people should be paying attention to as they get into fixed income, which is a lot more valuable now than it was 2 years ago. To your point, Kirk, we got under a 0.5% yield on the 10-year treasury during the peak of the whole COVID mess in March of 2020. So certainly people should be revisiting fixed income, whereas it, maybe not so much a couple of years ago. But for right now, educate yourself on what the yield curve is and be aware of what an inverted yield curve is. Forget about whether it's a predictor of recessions. Most of the time it has been, but it's not always. And sometimes investors get things wrong, believe it or not. So I would say be very aware of what an inverted yield curve is, and where you are looking at fixed income. For us, we would be focusing more on the short end than the long end, whether it's corporates, high yield, treasuries, anything. We would be much more focused. Now, if it's just straight income and you're okay with a 3, 4, 5% yield, then by all means, have at it. Go buy a 10-year bond. But if you're thinking more in terms of maximizing your income, we would be focused more on the short end and let things play out over the next year or two and see what longer dated securities look like.
So before we get to Phil, I want to ask you one follow-up question on that. So I noticed in agency, I don't know if you know agencies, but the agency
Sure.
market has been reasonably higher than treasuries, and
Yep.
they have similar risk profile. So we're looking
Yeah.
at 5.5, in some cases 6 for the 10 years in the agencies. What do you think of the agency market? Because to me, that just stands out as like, what's going on here? Why is it so different?
Yeah, so for folks that may not know, so agencies would be like Ginnie Mae, Fannie Mae, Freddie Mac, lots of the they're basically GSEs, government sponsored entities that are basically not backed by the full faith and credit of the United States government, but do have implied backing from the United States government, which is worth a little bit less than it was not so long ago, given the fact that we almost defaulted, but we'll save that conversation for another time. So, certainly, if you're getting 5.5%, 6% compared to like a 3.6 or a 3.7 on a 10-year treasury, that's an awesome yield pickup. That's a great advantage. I do think that spread sort of eternally widened out after 2008, because a lot of those companies do have fairly concentrated portfolios in the mortgage market. And with everything going on in the real estate market right now, I think that's probably why you have some room for caution. There are a lot of people out there that think house prices are in a bubble. And if that bubble bursts, the portfolios for companies like Ginnie Mae and Freddie Mac and Fannie Mae are going to look pretty challenged. And you don't want to run into like a 2008, 2009 insurance company scenario where you find out, so-and-so insurance company wasn't managing their general account well, or a sovereign bank where their durations weren't matched up. It's you only find those things out when the bad stuff happens or when the water drains from the pool. So certainly that's an advantageous yield pickup, but do be aware of the risks. Those are government sponsored, not government backed.
Yeah, that's a great point. And I want to make one point. I want to get Phil's opinion here, is that insurance companies, so banks have a little bit more of a problem because they could effectively go bankrupt if they mismatch their maturities and yields, whereas insurance companies don't. Insurance companies can just hold the maturity. And you remember 2008, the only insurance company that had a problem, AIG, was doing some crazy stuff, which was not really normal. But you didn't see any other problems from insurance companies, right? AIG did it because what they did was basically selling insurance on stuff they shouldn't have been selling insurance on, and that was just bad business. But every insurance company, they had problems in their portfolios too, but they didn't have to realize it. And I think this is the interesting thing. Just because it's not realized doesn't mean there aren't problems in the company. But as long as they hold to maturity, they don't have to default, and as long as they don't have a huge claim, which, if the whole United States is if every house is burning and everyone has a house fire, they're going to have a problem. But if it's just a small segmented piece, they'll be fine, which is how insurance companies have been around for hundreds of years. So, Phil, I want to ask you too, because the fixed income market is really attractive at 5%. So what do you think of the fixed income market? What do you think, what would you be doing here? Like, are there opportunities people should be considering?
So similar to what Tim said, it is much more attractive. I like the interest rates. I was using a lot of ETFs before. I have switched, and especially when it comes to the treasury part of the market, I'm very content to buy treasuries and do ladders. I mean, I even have people, I'll go beyond sometimes that emergency fund amount and say, look, if you have a house you want to buy, I'm even willing to say, you know what, like, that's money. It gets to the same point. I don't want to have $12,000 become 10, but if I can take that, and you're going to be buying a house within the next year or the next 2 years, whatever it is, I can ladder some treasuries within that time frame too, so that you have the ability to let that money safely grow. That spread that you see on the government agencies, that is interesting. It is worth considering whether or not to put some of the portfolio, but it's just such a different market than what we've gone through really for a lot of the last decade plus, right? We started lowering rates in 2008, and it wasn't until last year that we started to move them up. We had that zero rate environment for so long. So it's nice to see from a fixed income standpoint that we can finally get a return. So I think where the rates are, I can be in the safer part of the market. and I can get you a decent yield. So the fixed income portfolios for my clients are changing from what they used to be.
Awesome. So let's wrap it up here. So Phil, where can people find more about you?
So my firm is Apprise Wealth Management, and my website is Apprise Wealth, APPRISE wealth.com. You can sign up for my blog. I have an ebook that you can download, and you can also schedule some time if you'd like to talk.
Awesome. Well, thanks for coming on, Phil. Tim, where can people find more about you?
Yep, everything for us is at metricfin.com, metricfin.com. And for folks that are interested, we do have a weekly report. It's called our Factor Report, and it's basically a summary of what goes on in the markets every week, what happened, why did it happen, where did it happen, and then we'll include 3 what we consider to be timely and interesting financial planning and investing articles. By being included on that list, we do make appearances pretty regularly, or we have recently anyway, on some of the local stations like CBS, Fox, and NBC, talking about topical issues like the debt ceiling, inflation in the Federal Reserve. Hopefully, we're going to be doing some conversation about artificial intelligence pretty soon. So we do include those updates on our Factor Report, our weekly distribution list. So feel free to reach out and we'll get you added.
Great. Well, thanks for coming on. That's the show for this week. Thank you again for joining us on Money Tree Investing Podcast. My name's Kirk Chisholm, Wealth Manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on this show. You can also check out our show at Money Tree Investing Podcast. On our website, you'll have access to the show notes, resources, and the archive shows. Please remember to subscribe on our YouTube channel for immediate access to the new shows when they're released. When you subscribe to the show, it allows us to get access to some of the top minds of investing in personal finance. While you're here, please leave a comment and question if you want us to address it on the show. Have a great week ahead, and remember, no one will care about your money like you do, so invest in your life.